Most traders are addicted to indicators, but what if I told you you don't need any of them to enter the market with precision? Today, I'm going to show you my 3-step entry model that I use every single day. Simple, clean, and powerful. If you have been struggling with late entries, fake signals, or confusion from too many indicators, this is for you. No RSI, no MACD, no moving average, just price pure action. Let's get into it, guys. Let's dive in. So now, first of all, is we are going to identify liquidity, because liquidity is what really moves the market, or what really drives the market. You understand? So how are you going to find liquidity? I've taught you guys about liquidity. We have equal highs, equal lows, previous highs and previous lows, support and resistance. But in this particular entry model that I'm about to teach you, we are going to be using our daily highs and daily lows, or our 4-hour highs and our 4-hour lows. These categories falls under the previous high and previous lows of any candlestick. So this is our 1-hour time frame, and if you want to say a previous high and a previous low, it should be like this. This should be the previous high and this should be the previous low. Do you understand? So, but we are going to be using our 1 hour. Our 1 hour is what we're going to be. No, sorry, guys. Let me calm down. We are going to be using our 4-hour time frame for our previous high and our previous low. That is what we're going to be using. So, first of all, let's go for an illustration. If this is our 4-hour time frame candlestick, then what are we looking for? We are going to mark out the previous high and the previous low. This will serve as our range that is going to formulate or produce our entry setup. Now, remember, the first step is finding the liquidity. Where are we finding the liquidity? In our 4-hour highs or our 4-hour low. Jot it down. Okay, so you go to any 4-hour candle, mark the high and mark the low. That is where liquidity lies. You can call that the sell side liquidity or the buy side liquidity. Anyone you want to call it is your choice. You understand? So this, after marking this out, what next? Sweep of liquidity. We are going to wait for a sweep of liquidity. It's either by sweeping the liquidity to the upside. This is the open range of a new candlestick. Is either by sweeping liquidity to the upside, or we are sweeping liquidity to the downside. One thing must surely happen. Now, you may think this is the strategy you already know about. No, this is a different one. This is a different entry model. You can understand. So, after marking the high and the low, you wait for your sweep of liquidity, neither to the high side or neither to the low side. One liquidity must be swept. So, let's say price down sweep liquidity to the upside. This is now our liquidity sweep to the upside. What next are we going to wait for? We are waiting for a confirmed entry with a structure shift. Remember what I said, that a confirmed entry with a structure shift. Now, what is a structure shift? A structure shift can also be a break of structure or a change of character. Do you understand? But after a very deep thought and a very deep back testing in this particular model, I think we are going to be formulating and using what we call the model 1 formula. It's easy, and with the model 1, you can be able to catch entries faster than someone waiting for a structure shift. Do you understand? We are two traders. One trader focuses on the model 1, the other trader focuses on the structure shifts. Model 1 forms first before a structure shift. So before the structure shifted, the model 1 trader is already in, and also in the profit side before a structure shift. Do you understand? So let's go for a model 1. Fast entry, fast result. So what is the model 1? Let me show you. I'm going to be using a candlestick as illustration, not this one. So this is the open. This is the open. Now, after the 4-hour high and low, we are going down to the 15 minutes, guys. We're going down to the 15 minutes for this particular illustration, okay? So after the 4-hour marking of the high and the low, we go down to the 15-minute time to wait for the shift or for the liquidity sweep. So this is our liquidity sweep here. If this should be the liquidity sweep, wait, let me take this down. This should be our liquidity sweep. This should be the week. I'm not that good in graphics. So, really, okay, what am I drawing? Okay, can I enter in the middle? Okay, let's take it out. Let's draw this in full. So this is our liquidity sweep to the upside. Now, what are we expecting? What is the model 1? Now, that particular candlestick that causes that particular liquidity sweep, you're going to mark the under of it. You mark it here like this. Bam. That candlestick, that place that you marked is called the model 1 entry. This is the liquidity sweep. This is the candle that this is the arranging. This is the candle that causes the liquidity sweep. You mark the bottom of that particular candle, the wick of that particular candle. That is a model 1 entry. So the next candle might open from here and give us something like this. Boom. Then what are we expecting? We're expecting a retracement to this particular place, SL here, and TP here. This is what we'll be waiting for. Do you understand? This is more than this, so this risk to reward ratio is more than this. It's just because we're using illustration. But let's dive into the normal market analysis. This is our 4-hour candlestick on the 16th of June. This is our 4-hour candlestick. So as what I say, the first step is to mark out, to find the liquidity. And finding the liquidity, you're marking out the high and the low of that particular candlestick. So after marking out the high and the low, we are waiting for what? A liquidity sweep, neither to the upside or to the downside. That is going to be done in the 15-minute time frame. So if you go down to this 15-minute time frame, okay, this is the high that we marked and this is the low. If you go down to the 15-minute time frame, you can see something, guys. What do you see? What do you see here? You can see something. This is the low here. This is our candlestick. This is the candlestick that causes this particular liquidity. This candlestick is the one that purges that particular word liquidity. So after seeing something like this, you mark out this place of the candle. This is called what? Our model 1. This is our model 1. The place I marked out, is our model 1 entry model. And now, what are you waiting for? After marking this out, you're going to wait for price to break above it and closes like this particular one. Price opened from here, stopped here, opened again from here, goes down a little bit and start going up. Then price closes above this particular area that we marked. Once price closes above it, this area is now valid for entry. Then the next candle opens and retraces into that particular area and taps us in. That is where we are going to start stacking in our buys entry. Remember, what is our confirmation? There must be a close above. A candlestick must close above the area that we marked in. Remember, where are we getting our area from? We're getting our area from the particular candlestick that causes that particular liquidity. That is where we are getting our area or our model 1 from. Stop loss should be below and our TP should be above here. You can see this gave us what? A 1:4 risk to reward ratio. As sweet as that. I can show you this pattern again and again and again. Let me show you another one, guys. Okay, guys, this is a new set entry. Yeah, these are sell scenario or sell example. Price, this is the high and the low of this particular 4-hour candlestick. Then we go down to our 15-minute time frame to mark out our model 1. How are we getting our model 1? That particular candlestick that causes that particular liquidity sweep is what we are going to mark as our model 1. So now this is the high, and what candlestick causes it? This particular candlestick. This is the candlestick that causes this particular liquidity sweep. Then we're going to mark there as our model 1 entry. Then now listen and watch attentively. This first candlestick tries to close below it, but it didn't. Shows that this entry is still invalid. This candlestick must close below it. It is a must. It must close below it. If you are buying, it must close above it. So it produced a new candlestick, and this candlestick did what? Closes below it, making this particular entry what? Valid. Then the next third candle now give us the sniper entry that we are looking for. SL above here. If we should pull our TP here, this should just be a 1:1.5 ratio. But we're targeting the draw, our nearest draw in liquidity. Where's our nearest draw in liquidity? Our draw in liquidity should be, we have 3 draw in liquidity here. We have 1, we have 2, we have 3, and so on. So we should be targeting this. Still not enough for some traders. Then we should be targeting here. This should be at least 1:5 risk to reward ratio. And you can see price even give us at least, before reversing, price give us at least 1:4 risk to reward ratio, sweet and clean entry. It's not that you don't lose. You lose, but the win rate is always high. Any win rate that produce 1:5, 1:4, if you can catch that 5 times and lose 5 times again, you are seeing a profit side. Do you understand? You are seeing a profit side. So, as I said, I can keep on showing you guys more example upon example upon example upon example. But remember, patience is what? Patience is key. Patience is key. Okay? Now, always your risk management matters a lot. Okay? Your risk management matters a lot. You need to calculate it very wisely. Wait for that. After marking out that particular candlestick that purchased that liquidity, wait for price to close below it or above it for you to make that place valid. If there's no closure, don't trade. Okay? If there's no closure, don't trade. Wait for a closure for you to make it valid. Then your stop loss should be above that particular candle, above the liquidity high. Like this, your stop loss should be above here, while your take profit should be the next liquidity zone or the next draw in liquidity. Go and study draw in liquidity. I have the PDF. I can give it to you. If you need the PDF of draw in liquidity, you can chat me up. I can give it to you. Okay. The next step is to target the next draw in liquidity. Make sure you get that particular draw in liquidity. You understand? So you can aim for at least 1:4 or 1:3 risk to reward ratio. No emotions, just follow structure, follow price action, and we are going to really enjoy from this market. You understand? Now, some common mistake that most beginner trader does in the market. Most trader, they fail because they enter before this particular sweep. You might say that, okay, price already done this sweep now. Then what next? Bam, you start entering your sell without waiting for any confirmation, without waiting for any model 1 confirmation. You will lose. You will lose. Make sure your model 1 is confirmed before you enter any trade. You understand? Some of them, they ignore structure. We follow the structure. Learn your daily bias. Learn the market structure bias. Are we bullish or are we bearish? If we are bullish, then you are going to be only looking for a bullish momentum or a bullish setups, a bullish opportunities. If we are bearish, we are going to be looking for bearish entries or bearish, only bearish entries. You understand? Thirdly, do not trust the trade. Once you place the trade, wait for that trade to run out. Don't struggle yourself, okay? wait for that particular trade to do what? To run by itself. You can see how everything just tapped in and boom, you start dropping. No noise. Do you understand? Okay. So remember, when there is no sweep, there is no trade. Okay. Now, this 3-step model is very simple, but don't underestimate it. All you need to do is to master this, and you will start seeing the market differently. Do you understand? Now, if you found value in this video, drop a like, subscribe, and I'm going to see you in my next video. See you guys next time. Peace out.